All right.
Hey guys, I'm Tam with Huntington and Ellis, and I'm here today with the awesome Andrew. He is the CEO of PIF Lending, which is a top mortgage brokerage here in Las Vegas, Nevada. He's also a fully credentialed underwriter, and I wanted to get with him today because there's been a lot of change lately as far as interest rates are concerned, and he is definitely an expert on this subject. So, Andrew, if you'd be so kind, tell us what the hell is going on with interest rates right now.
Well, thanks for having me, Tam. I think everyone has seen it at this point, whether you're a consumer or you're a real estate agent or even a lender. Rates were in the twos a couple weeks ago, and now across the board, we're seeing threes almost no matter what, into the fours. And if we're going investment or secondary residence, we're seeing even into the fives. The craziest part about it is, 1% in the interest rate and the payments just go through the roofs. And that's been kind of the biggest thing is, we've been telling people buy low, because the rates are super low. They've never been any lower in literal history.
Yeah, that's true. Is there like any kind of like a general calculation or general idea that would help people understand like a 1% interest rate hike, like how much that would lower somebody's purchase power? Like if somebody could purchase, a $400,000 house at 2.5 last year, or 2.75, what could they be able to purchase this, right now with 3.75?
So, in interest rates, they break them down in the eighths percent, right? So essentially, if you had 2.75, that would be 2 3/4. And just going to 2 5/8, which would be 2.875. And I know I'm getting super math here, but basically, every eighth of a percent is going to be about $30, right? So if you go up an entire point, you're talking, $240 a month. That's going to be about $100,000, maybe a little bit short of it, of difference in what you're going to qualify for on the purchase price.
Oh my God. I'm taking notes here. Approximately $30 for every eighth of a percent.
Give or take. It depends on the rate. It depends on their credit score, but that's just going to give you a general figure. And obviously get a quote, make sure before you actually go and try and find a house, get the quote from the loan officer, but that's going to be your average.
Oh my gosh. Well, I already blew you up all week about mortgage rates, but I literally almost fell out of my chair because I was just browsing online, just thinking about doing a cash out refi on my own house. And I thought there's no way this has to be wrong. There's absolutely no way.
And here's the thing, we're going to start to see ARMs come back, right? So ARM stands for adjustable rate mortgage. And, usually when I say that, most people, their hair on their arm starts to cringe. And I would tell people, don't freak out. The ARMs nowadays are so incredibly safer than the old ones back in the old days. And old days, I'm referencing the 2008 crash, right? These ones, they're fixed for a period of time. They can't just go flying off the chart. They don't have negative features into them. And here's the easiest way to say it, right? How many times have you been in a house longer than 10 years? How many times have you had the same loan for 10 years? Almost virtually no one has, right? So, consider an ARM if you're going to be doing a home loan at this point, whether it's a refinance or a purchase. Chances are you're going to be out of the house before it even has a chance to adjust.
Yeah, and isn't it true that the first 10 years of any mortgage, it's super interest heavy anyway, so the vast majority of the payments are already going towards interest no matter what?
Correct. So any 30-year mortgage, that first 5-year duration is always going to be the most expensive when it comes to interest. But, if you can get a 5/1 ARM, and I'll explain what that is here in a second, but if that rate's at 2.75, 2.875 versus the 30-year fix, which is at 4%, well, now you're talking about a point difference there in essential interest rate, right? So now we come back to that $240, $250 a month. Well, take 250 times 12. What if you had that lower rate? You're taking that 250 each month and applying it towards the principal balance. Now, when that rate gets to the point where it can adjust, well, you've already paid off $50,000 more than you were going to on the fixed rate. Now you're refinancing, you have a lower payment because you have a lower balance. So I was going to go back. Oh, the 5/1 ARM. So what that means, if you hear 5/1, 7/1, or 10/1, all that simply means is it's fixed for the first 5 years, and then it can adjust after that, or 7 or 10.
This is why I love you, because you're a freaking genius.
Well, it only cost me my hair.
I know there was also some pretty major changes to self-employment loans. That was a big problem during the pandemic. I know you saved a bunch of loans for me and for tons of other agents around the city because it came to a point where you were pretty much the only guy that knew how to get them done because there was issues with the P&Ls having to trend a certain way with the bank statements. So what are the updates that have come to that?
So the good news is that they've taken a lot of the requirements from the profit and loss statements away from what there was put in place from COVID or the pandemic, essentially. In a short summary, basically what they were looking for versus just having a profit and loss statement, they wanted to see that the bank statements also supported that profit and loss statement. Now, majority of those businesses actually did support, right? At the end of the day, no one's self-employed, not making money, continuously do the job for free. So but the average self-employed borrower, they're not the accountant. They have the CPA do it. They go to them at the end of the year and they do it all at once. They don't do it in the middle of a loan transaction. So that was the hardest part. We actually had one transaction that they were moving from out of state. They ended up getting here, loan fell apart. And long story short, they were going to be moving into an apartment and they're an elderly couple. We got it the last day. I think it was 10 days we got the darn thing closed. VA self-employed. It was a whole thing. But at the end of the day, it's just, here's the best way to say it. We're loan officers. We're not accountants, right? And so, my underwriting background does help me quite a bit with looking at tax returns and looking at the cash flow. But a general loan officer is not going to know how to put together an entire profit and loss statement. I also own my company. So, financial statements for me are very normal. Again, the average loan officer doesn't. And I'm not saying that's a bad thing. It's just, it comes down to, you're having consumers who don't do this for a living. You have loan officers who never trained them to do this, and it's not in our licensing curriculum. It was a bad mix.
Yeah, I'm sure it was stressful on both ends, not only for lenders but for clients. I purchased a new house. It was under construction for like 8 months. I closed in August, but even when I did my P&L, I have multiple bank accounts. So there was thank God I had plenty of income to support it, but there was two huge commissions that I had accidentally wired into the wrong account. So I wired them into my personal. I never included them on my P&Ls. So that could have been like an example of a situation where if that was already submitted to the underwriter and it wasn't enough income, then they're like, whoa, what's going on? None of this trends.
And that was the whole main concept that they were chasing, is they wanted to see those recent deposits to go ahead and show the income was still trending. The business is still alive. It's not impacted by COVID and shutting down. So, something like that, if you don't have an abundance of income, it could be very devastational for the loan process.
Yeah, I can only imagine, because especially based on the levels of commissions or what type of business the person's in. Maybe it's a business where somebody sells, jet airplanes and they sell 2 a year. Well, what if they had nothing in contract for 6 months, but they made $1 million profit in the first quarter? So,
and we can explain stuff like that. Let me back up. If it's common sense and it is your normal business ebb and flow, then you can get it done that way. It's very common, a Christmas tree owner or a Christmas tree lot owner only sells Christmas trees in 30 days at the end of the year. And in that 30 days, he makes his entire income. So, for the jobs that's normal expectation, that was okay. But what they were really looking for is, we're a mortgage company. We don't just stop doing loans in the middle of July in March of 2020. In fact, we actually got busier. So if for us not to have an income during that month, it would be very weird. And that's what they were trying to see. They were trying to see, okay, why are you not working right now? You should be busy as a self-employed owner.
That makes so much sense. So I wanted to ask you, when you're looking at rates, because I know, I've been to your office many times. You have the screens behind you. There's screens in front of you. In your home, you're wrapped in like a bubble of screens, and you're constantly watching different markets. Towards the end of this, whoever wants to stick around for it, maybe we'll talk a little bit about Bitcoin if we have enough time. But as far as the financial markets that drive interest rates are concerned, when do the Feds release new rates? Why do they release new rates? And what are the factors that kind of affect the rates that they put out?
So the biggest one that we all have to really just keep our focus on, if you remember last year, basically they said they lowered the interest rates to 0%, right? And so everyone thought that meant car loans or credit cards or mortgages all went to 0%. And while it's not necessarily those, what they did is on the Fed funds rates, that's basically saying, hey, if I'm Bank of America and you're Chase, we can go borrow the money from the federal government for 0%. And so Chase and Wells Fargo and Bank of America, all of them were able to borrow it for 0%. Now, then they turn around and that's what they're using as their capital for their lending products, for their mortgages, for their cars, et cetera, et cetera. Now, here's the reason why they do it. When they lowered those interest rates, when the banks were able to borrow it for a very inexpensive cost, that made them loan out the money for a cheaper cost. Well, what does that do? Well, hey, if I can go refinance this car and get a rate of 1.99, let's do it. If I can go buy the car, buy the house, or buy whatever they wanted to buy, what you're doing is injecting liquidity into the economy and making it very affordable to go ahead and get new things or get your current things refinance for a cheaper cost. So that's the reason why you lower rates, right? You want to go ahead and step on the gas, throw some nitrous in the engine, get the economy running, and just go full blown. That's what it's for. Now, the problem with that is when it becomes too cheap, and that's essentially what happened, right? You were able to go out in December of 2020, you could go buy a $500,000 house at an interest rate of 2.5%, 30-year fixed conventional, and your mortgage payment was going to be $2,200 because the rate was so low. So when that happened, you have all the buyers that are coming from California, and it's not just them, it's also the Pac West from Washington, Oregon, where those are all coastal states as well with incredibly high price points. They're coming down here with cash. California's coming over here with cash. Everyone can finance anything they want because it's the cheapest it's ever been. And everyone plows, right? So what that does is huge demand, not enough supply, prices go up, right? So as this continues, this is what causes inflation. If everyone can buy it, then, well, everyone can buy it, and that's going to be no more supply left. There was a commercial going around on TikTok. It was like, I got an apple. You can't touch the apple. And it was this huge thing on TikTok. But the point is, like, you know it's an apple. You want to pay $10 for the apple? And that's the problem, right? So I'll summarize this and come back to the end of it, or the beginning of it. At the end of the day, when the prices flew off the chart, well, now they have to start increasing interest rates. And here's the reason why. When they increase the rates, well, now if you want to go buy that $500,000 house, it's almost $3,000 a month, right? Well, that's an exaggeration, but $2,600, $2,700. And so, well, do you really want to buy that house now? Or can you live a little bit lower than that? Maybe you can go to a house that's $400,000. Well, do you really need the new car? Do you really need to go get that laptop that you're going to have to finance on the credit card where the interest rate just went up, right? So high prices fix high prices because now people are going to second think or give it a second thought of, maybe I shouldn't buy it. So the feds are doing this because inflation right now is at the highest point it's been in 40 years. It's insane at the moment. And if they don't get control of it, we're going to blow past the Great Depression recession inflation rates. And obviously everyone knows what that was. It was a very bad economic event. So they're going to continue to increase the rates until they can get the economy to slow down a little bit, get the inflation under control, and let things settle down. And I know that was a really long answer, but it's really hard to answer in shorter.
No, it's great information. So, but you made me think of something else. So are HELOCs affected the same way? Are all HELOCs adjustable rate loans? And then are they affected by the same driving factors?
So nearly every financial product is all affected by the Fed funds rate. So if Bank of America has to pay more to lend that money out, then you're going to pay more because they're not going to pay it. So if they have to pay less, then that means you're typically going to pay less. If it's harder for them to get funds, it's going to be harder for you to get funds. So HELOCs, yes, you're going to see those rates naturally rise. Now, you can get a fixed rate payment on a HELOC. And if anyone doesn't know what a HELOC is, it's a home equity line of credit. But nonetheless, you can get a fixed rate. But I come back to the point of why, right? Chances are most people, and let's pretend we go into a little bit more of a recession, right? Maybe values drop and people get a little bit upside down. It's never going to be like 2008. That was all because of loan fraud. But my point is that maybe you're upside down for 2 or 3 years and you have an adjustable rate mortgage and you're worried now you're stuck. Well, if you look at the housing economy for the last 70 plus years, no matter what recession that we've gone through, including 2008, prices have always appreciated 3 to 5%. So by the time you're going to get to the point where the HELOC, if it went to an ungodly rate, if your first mortgage went to an ungodly rate, you might have been married or got a promotion or moving anyways where you're selling the darn house. No one keeps houses now for 30 years at all. That's an old way of thinking. And I haven't met one person in my entire 11-year career pay off a 30-year mortgage and took the entire 30 years to do it.
Yeah, no, I mean, that's a good point. I think people, they move depending on the phases of their life, how many kids they do have or don't have, or, if they have a partner, don't have a partner, or, want to walk up the stairs, don't want to walk up the stairs, all of those lifestyle driven factors.
Here's the averages. Nationally, it's 7.5 years to pay off. Las Vegas, it's 4.5 years.
Wow. Mic drop.
Right.
So one thing I always love to talk about whenever I get the chance to get on with you is the difference between a mortgage broker and a mortgage banker. This was something that I was very passionate about. I still am very passionate about it. Always have been since I, got licensed in 2019. Sydney Johnson, she was, awesome. You know her really well. She really helped to kind of, educate me and get me down that path. And then you and I met, and it was just been awesome. But you and Sydney, saved my clients thousands and thousands and thousands of dollars, not only in lender fees that become part of a buyer's closing costs that they did not have to pay, but you've also been able to get them the actual lowest interest rate that they qualify for, whereas a regular banker / regular lender is able to kind of hike the rate a little bit and add fees on the front end, which and then they're going to make fees on the back end when they sell it either. So that's normal practice. I'm not saying there's anything inherently wrong with that. It's just there's a big difference in the cost out of the pocket of the buyer.
Correct. So, there's 3 channels of mortgage. I'm not going to go into details because it's just too complicated, quite frankly, but you have your wholesale brokers, that's us. You have your mini correspondent bankers that can fund and look like they're the bank, meaning all the documents are in their name, but it's not really their funds either. And then you have your correspondent bankers where it is the docs or the name on their docs and they're actually funding it. An example of what those are would be a Wells Fargo or a Bank of America. So here's the point. When you are the actual bank or you're imitating the actual bank, well, because you're a banker, you don't have to disclose compensation on any of the actual disclosures. And so you might have heard back in the old days, back in the crash of 2008, there was points in the back end, there was points in the front end, and there was fees that had to pay. Well, they can do that and not have to disclose it to you because they're the bank. It's their money. It's their warehouse line. They don't have to disclose it to you. Now, for a wholesale broker, we're paid by the definition of a broker is really a third-party originator, meaning that we are not the bank, we are not the funding entity. We are simply the ones assisting the client structure the loan, submit their application, and answering questions. We all really kind of do the same thing. It's too long to get into, but the point is that because we're a third-party originator, well, any compensation that we receive, we have to disclose onto the loan estimate, and frankly, that's the way it should be. Now, when the crash happened in 2008, federal law came out and said, hey, we're going to blame the brokers, which, granted, there was a good chunk of brokers that were not playing fair. However, they ended up blaming the brokers and they ended up blaming the bankers, but bankers got bigger pockets, so they were able to get better union reps on that one. But federal law caps our compensation at 275 basis points. In English, what that means is we can make about 3% of the loan. A banker can go all the way up to 7% on the back end of the loan. And so, you might ask, if you're not a loan officer, well, how the hell am I going to know if I'm getting charged 7% or not? Compare the rates, right? If we're at 3.625 and you're talking to the banker and they're at 4.25, that's the difference in the back end of the margin. So, for pricing, we're going to beat a retail banker almost any given day of the week. We're going to run right in line with the credit unions. Sometimes we beat the credit unions. Now, the biggest difference is what they'll claim is, hey, well, the retail banks, they have the underwriters sitting in-house. And, they do, but in-house doesn't mean in that office. Underwriters usually work remote or they usually work in op centers. They don't let the loan officers next to the underwriters because that goes really wrong really quickly.
Yeah.
The biggest thing is that we don't need the underwriters in the office. We all sell to the same people. Everyone knows who Fannie Mae is and Freddie Mac and FHA and VA. We've all heard these. If you're getting a VA loan, the VA is going to buy it. And if you're getting a conventional loan, Fannie's going to buy it. At the end of the day, they're all the same guidelines. So you can get a better product. You can get the cheaper price. I mean, are we going to close in 7 days? No. Are we going to close in 15 to 20? Yes. Do we have more than one underwriter to go to? Yes. Do the bankers? Not a chance, right? You go to a bank, Wells Fargo, they only have one underwriting department. I got 35 lenders I'm signed up with. Hey, you know what? They don't like that flavor over there. And these people really like self-employed more. Let's go here. Let's go get that opinion.
That makes a lot of sense. And, it's funny because I've actually had conversations with other lenders where they literally do not believe me when I say, hey, no offense, but I'm not going to use you just because my clients don't need to pay all that. They don't believe me that it's possible to get the rate that they're going to get and not pay the fees. And I literally sometimes have to show them like a loan estimate and they've never heard of it. And I mean, it really comes down to loan officer compensation. So you make considerably less on each loan than a regular lender. Why do you do that? Like, why would you want to, put yourself out there and work as hard as you do and, make about half as what you could make if you just go back to, working for a traditional lender?
So, the network is always the most valuable piece. And I think everyone's starting to come to the realization that data is king. If you have the data, if you have the database and your past clients, you can't be touched in that sense. And what I mean by that, not that anyone's untouchable, if I'm able to do 3 or 4 times more clients than the next lender across the street, Well, that just means I have 3 or 4 more clients that want to maybe do a refinance later or do a cash out refinance later, or they need to help their son, their family, their friend, whatever it might be. And so, I chase more of the volume aspect of it. And I'll just kind of give you an idea. The initial years of my career, 15 million, 17 million, then it went to 30, then it went to 60, then it's going to 100. So, when you do in that much volume, when you're doing hundreds of units, you're just making hundreds of more new connections, and that network gets bigger and bigger and bigger. And sometimes it can be fun to try and chase and keep it all together, but there's growing pains with anything. And my clients come back to me because they know at the end of the day, if I don't like the deal, I'm going to tell them I don't like it. They shouldn't do it. And if I can get it done, and I give them that word, we're going to get it done.
Definitely. You closed every single one of my loans that you've ever even hinted that you would be able to close. So basically what I'm hearing you say is at the end of the day, it comes down to relationships and building that longevity of relationship with your clients.
Correct. Can I make more? Sure. Do I love what I do? Yes. Would I like to have a little bit more hair? Kind of.
You keep collecting all these loans, Andrew. You can get some new hair.
Yeah, I'm working on it. There's absolutely nothing that drives me more passion in this business that when I have a client that was told no, or they got declined, or they're in escrow and it's falling apart. It's not that I want the adrenaline. It's just like, all right, well, let's turn over every damn stone there is in the place. And then after that, maybe we'll say we can't do it. But until then, let's keep flipping.
I love that about you guys. I love that about you, and your entire office is kind of like that too. Like Vanessa and anybody that I deal with at PIF Lending, they're always just committed to seeing things through to the finish line, no matter what.
I always say that Progressive Car Insurance, they have those little price guns. We just have duct tape and super glue just on their side. We're ready to go.
Duct tape, super glue, and I've recently learned caulking. That solves almost everything.
Yes.
And liquid nails. That's the other thing. Liquid nails.
Those can hurt too.
I'm actually going to revamp my realtor kit, like that I keep in the back of my trunk. It's usually like a measuring tape, a laser measure, things like that. I'm going to put just a caulking gun in there, some liquid nails, and duct tape, and we'll just call it a day.
Yep. I mean, you can't go wrong. Maybe a little caffeine, a little Monster or something.
That could help. Definitely. Right. So I know we both have to get off pretty soon, but what do you think is going on with Bitcoin right now?
Yeah. So, okay. Long story short, everyone's kind of gotten into crypto as of recent. Here's the one thing that you should know. If you are actively trading right now, just start paper trading. You can do things for free and practice and learn without losing thousands. Everyone says that crypto is incredibly dangerous or Bitcoin's incredibly dangerous. Understand it's just incredibly more volatile, meaning that it goes up and down. A normal day is 20% swings versus stocks are not. But here's my thought process. At the end of the day, we are now servicing, I think, somewhere in the almost $45,000 range. Basically, the consensus is in the community is, do we have one more high before we go down and retest a low? Or do we have another low before we go and retest a high? And what that means simply, are we going down into the 20s first, or are we going up to the 70s again first? And that's what a lot of people don't know. There's a trend line currently in Bitcoin that we've been riding on that we did break beneath, but we are starting to approach to get back above that trend line. Well, if we get back above it, that becomes a very strong level of support. So as they always say, who knows what it's going to do? Have your stop losses in place, which is how you protect yourself. And, don't put more than you can afford to lose. That's the biggest thing. Hedge funds typically will keep about 5% of their total portfolio management in risky investments, right? So if they have $100 billion, only 5% is going to be risky. Follow the rule. You might keep yourself safe.
Did you say paper trading or pay per trading?
Paper trading. So basically what it is, go to tradingview.com. Download their platform. At the very bottom of it, where you can hook up your actual brokerage, like if you want to hook up your brokerage account to actively trade, there's one that just says paper trade. They give you $100,000 of monopoly money. You get the adrenaline, you can get the practice. And if you start winning 60% of your, paper trades, then maybe throw a couple $100 in the darn thing. But until you start winning with the monopoly money, don't risk your money. Learn first.
actually an awesome piece of advice. How realistic do you think it is? So, I mean, a lot of people try to keep some, a year's worth of reserves. How realistic, like if somebody still had enough money where they had reserves in the bank where, if they lost their job or something, they could still pay their mortgage for a year. But what if they had like 50 or 100 grand to just kind of keep in crypto? Do you think it's realistic that somebody could, set the stop losses and be able to make, 1% a day on that money if they just made one trade a day?
So Bitcoin has a very unique fact about it. Basically what it is that there's 11 days in the calendar year. Out of the entire 365, there's 11. If you're not in Bitcoin in those 11 days, you actually lose money significantly. Now, that said, year over year, you are up just thousands because it does go up over the timeline it's been in existence, which is 13 years. So here's what I'm simply saying. You can set a stop loss to go ahead and sell off when you're done with the risk. But at the end of the day, the best way to approach it is what's called dollar cost averaging. And dollar cost averaging simply means is that you put in a little bit each day or each week. And here's an example. What if you put in 10 grand today and today was the high of the market? Bad day for you. But what if you took that 10 grand divided by 365 or however many times you want to put it in, maybe 200. And every 200 days, you just put in $25 or whatever that number is, right? Well, you're never really going to get the high. You're never really going to get the low until it averages and blends together. So that way you're not going to go for the highest price or the lowest price. And chances are you're probably going to be in there when it's going to be those 11 days.
Wow. Tradingview.com. I'm definitely going to look into this. That was awesome. And then anybody watching in the comments, if you're interested in Bitcoin and cryptocurrency and you want to hear Andrew talk more about it, let us know. Otherwise, we won't bore you with this kind of stuff in the future. But
and real quick too, so gold, silver, precious metals, they have been on a low. Get ready to see gold go for a little bit of a run. The dollar has been on a screaming just all-time, not all-time high, but just really strong dollar. Prepare for that to come back a little bit. What goes up must come down. What goes down usually has a chance to bounce and go up. So all markets are going to be very interesting. And I'll leave you with this. When you see these markets, the Dow, crypto, when they move so volatile, and the Dow last week, it opened up 1,000 points low, then it made it up in the same day. When they're this volatile, understand that you are not in a normal market. You are in a bear market at this point. This is when we are in a market that is going to be crazy because in volatile bear markets, that's when they swing this much. A healthy market, it doesn't swing this much. So just be careful and do as much research as you can before you risk your entire life savings.
Wow. Thank you so much, Andrew, for all the information that you gave us today. I will, I'll put your website link in the comments below. So if anybody wants to check out his website, I'll put the application link too. If anybody is ready to apply for either a new purchase or a refi or a cash out refi, I'll put that link in there for you below as well. Thank you again so much. And again, I'm Tam Gonzalez with Huntington and Ellis. Obviously, my contact info is on my page. Andrew Levitt, PIF Lending, his contact info is on his page as well.
And just to clarify, my hobby is crypto. I'm not giving financial advice.
Yes.
Sure. Don't listen to me.
We also love cats.
Yes.
Cares about cats.
Yes.
Just like my shirt clearly displays.
See, you're always so colorful. I got this boring, just
I love my lion shirt. Don't worry, I'll get you one, Andrew.
Okay. 2X, please.
All right.
You guys